This week, I made two quite significant buys with rather large deposits, and this was simply to follow my strategy of cost averaging. Both companies saw a massive drop of around at least 10%, so I wanted to capitalize while they were quite cheap and buy more of the stock while I could. I also made these investments despite all the noise going on, warnings of another dot-com bubble. A lot of people are saying the tech stocks are just completely blowing up recently and it's all going to collapse soon. So I kind of wanted to talk about that, like a repeat dot-com bubble, and why it could happen, but also kind of my thoughts and opinions on it. And also explain how, if it does happen or doesn't happen, how it's kind of affecting my investment strategy. So for those of you who didn't know, the dot-com bubble occurred during the 1990s, following the rise of tech and internet companies. People obviously saw them as a future, rightly so, and was piling loads of money to buy equity in poorly run and unprofitable companies simply because they involved the internet in some sort of the other. So the Nasdaq, which is an index that is mostly compiled of large tech companies, it fell almost 80% in 2001, between 2001 and 2002, and it's only just recently recovered 15 years later in 2015. So I believe it was around 5,000 US dollars. It dropped all the way back down to 1,000, and it's only recently just recovered in 2015. So in the bull run, which the bubble was built behind, the Nasdaq rose fivefold in 5 years. So this created an atmosphere of market invincibility, and investors were speculating on anything with .com in the name. And all this speculation meant that the Nasdaq PE ratio went up to 175. So people that don't know, a PE ratio is price to earnings. So that means every £1 all the stocks in that index earned, an investor was paying £175 to own a share of that £1 revenue that the company earned, which is absolutely incredible when you think about that. So another way to look at this is the average today, the Nasdaq PE ratio is around 25. So PE ratio isn't a determinant fact on value, and it can differ for different reasons, because mainly it looks at the company at a specific point in time, and it doesn't account for any potential growth. So it just looks at what the company's earned versus how much it owes and all that kind of stuff right now. So some investor could be looking at it and seeing 175 PE ratio, but they could justify it simply because they're saying the internet is the future and it's going to grow exponentially, and my money can grow 100 or 200 fold. And they've got that kind of mentality where it is invincible because of it's been blowing up so rapidly. So people think this is happening again because the recent rise in tech stocks in recent months, particularly Apple, Microsoft and Amazon, since their March lows, they're actually up around 70 to 80%. So these three stocks, along with Google or Alphabet, the parent company of Google, and Facebook, they make up 25% of the S&P 500. So out of 500 companies in that index, 25% of it is weighed within 5 companies, which is incredible when you think about that kind of the volume and power these companies have, or at least the value that people are applying to them in relation to all the other companies out there. So that means index fund investors who invest in the S&P 500, such as myself, who believe they're buying a well-diversified portfolio, ready-made portfolio, they're now heavily invested in just 5 large tech companies, which can be quite volatile. So again, to put it into perspective, Apple alone is worth 80% of the FTSE 100. So the top 100 UK companies, Apple is worth 80% of that index alone. One company is worth 80% of the top 100 UK companies. So whilst these companies do have quite an incredible market cap and market value at the moment, it is still very different to the dot-com bubble, because these companies are obviously adding value to the consumers, and they are meeting the demand of what consumers want. And they also have strong business models to sustain themselves. So Apple has over $200 billion, $200 billion in current liabilities, so cash reserves and things that they can sell soon, and they have that cash to fall back on. So that means they're in a very strong financial position if anything does go wrong. But obviously, these kind of tech stocks, they don't come without risk, even though they do have a strong business model. And like the example I had, Apple does have a lot of cash on hand. Much of Apple in particular success came from Steve Jobs, his vision and creativity, which most of the tech sector relies on. And it needs constant innovation, which can be very challenging. And that just means the risk is increased. It's hard to constantly keep improving and building what you've already done. So Steve Jobs did previously leave the company a few years back, and Apple suffered then. And obviously now, sadly, he passed away and he's gone forever. It means Apple's growth could stagnate. They might not be able to continue with that vision and keep creating innovative products like they have done. So, however, beside of that kind of the qualitative analysis, focusing on the actual money and quantitative side, Apple's valuation today, I do believe it is quite a premium. I think its PE ratio is around 35. But this is nowhere near the high values back in the dot-com bubble. And like I said, it's all about the fundamentals, the business model, how they create revenue. It's not people investing in them simply because they're an internet company or they're investing in tech and stuff. They are strong companies with real brand image and real products that people still want and are consistently buying. So Apple in particular, again, I'll go back to it. I am investing that directly. So I am buying Apple shares themselves. So in my pie on Trading 212, I've got about 1% allocated to Apple. So every £100, I do put £1 into it. And that the low valuation there is because while I think it's a great company, it is still quite highly priced. But if it does drop, I will be upping that allocation and putting a lot more money into it. And I also own some of Apple through mutual funds on my Hargreaves Lansdown ISAs. So that's why I'm not too worried about the dot-com bubble repeating. The statistics are very different to what it was back then. And them 5 companies, while I think Facebook and other social media companies are a bit weaker, because they do struggle to find solid revenue streams. I know Twitter's very struggling. I think they're still making a loss, and they are relying on just investors piling more money into them to keep them sustained. They do have that reach. I think it has like 200 million active users or something. So there is potential there, and there's people are hoping that they can work and capitalize on that. But as I said, I'm not invested in Twitter myself, because I don't think it's really there at the moment for me. And I'm invested in companies that pay dividends because I think they're more sustainable and better for my portfolio in the long run. But yeah, so overall, I don't think the dot-com bubble is going to repeat itself. So whilst there are stocks that do have very high valuations, a lot or are still recovering from their March lows, and they can be very good buys for the long term. So two big purchases I made recently were in British Tobacco again. I know I put some more money into it in my last video. I've actually topped it up again, and also Intel. So I deposited around £150 into each. British Tobacco dropped around 10%, which is quite a drastic drop again. And I think its dividend yield was just under 8%. So again, a very good buy, and I think it's a very strong company. I think no matter how hard it gets, I mean, I think real long term, a few generations, I don't think the smoking and this kind of unhealthy habits will maintain themselves. But I think in the medium to long term, 20 to 30 years, so the shorter than generations, I think British Tobacco is still a very strong company and they're very dedicated to paying their dividends. So that's why I'm investing in them. So another big drop was Intel. So this actually dropped in one day. It dropped around 20%. I think the exact figure was like 17.5% in one day. So it dropped to around $50. I did buy it on the day right at its low. I got in at a very good time. And this came after an announcement that they're considering not manufacturing their own chips. So if you don't know, Intel creates chips for PCs and Windows computers. And I think there's also developing chips for Apple, but obviously Apple's moving away to their own ARM-based chips. I don't know the details of computers and stuff, but basically Intel aren't making one of their or they made a statement that they might stop and they're considering not making their own chips. So this created a price drop. And with their price dropping down to $50, it was around their dividend yield increased to a very respectable 2.5%. And their PE ratio is down to around 10, which for a tech stock is very cheap, especially when you compare it to its competitors. Again, I mentioned the NASDAQ, which is around 25 a PE ratio, and its direct competitor, Advanced Micro Devices, is sitting around 145, which is an insane valuation. It has seen a massive jump recently when Intel did announce this. I think their plan is kind of swoop in and fill that market need if Intel don't produce it. So the reason I decided to double down on Intel is because it's now at a similar price to what it was back in March when the market acted like it was the end of the world, and the price dropped due to a statement that might not even materialize. So they said it, but it's not definite. And even if it does, Intel is a very large company and they've done very well and they've got a lot of great minds behind them. They wouldn't just drop something like that without weighing all the pros and cons. So not only does buying at a cheaper price this increases dividend yield, but Intel have consistently for the past, I think it's 5 years, increased their dividend year on year. So with an average increase of around 6.8% a year. Every year they're constantly increasing it. So it's obviously dedicated to paying dividends. So I just couldn't resist when I saw its price drop so drastically and I could get in and get it at quite a high dividend yield. So even though I agree it is a risky investment, I think it is one that will pay off and I am quite happy with that buy. So overall, the market has slightly decreased this week, and my portfolio is sitting around £14,300. So as I said, I did deposit that extra 150 to put into British Tobacco. The £150 I put into Intel was actually relocated from some of my cash. This is just because I didn't have any spare money to invest, and I keep my portfolio separate to my kind of day-to-day needs and other bills and stuff. So I didn't have more money to put into that, so I just reallocated some of my cash. So while my overall portfolio has been relatively stable, one area that has performed exceptionally well is actually my crypto portfolio. So it's up around 20% after a slight fall. Well, in the past month, really, it's been pretty stable, but it did drop a bit last week. So now it's up around 20% to just over £300. And so while it does feel quite good, it's currently being up. I'm not getting too excited. As you know, it can easily drop again. Crypto is very volatile, but I do plan to hold it for the long term and continue to cost average it. I think it's been going up recently due to the market uncertainty. The same reason gold has hit new peaks. I think gold's nearing $2,000 now an ounce, which is mental when you think a few months ago, before all this everything happened, it was sitting around, I think it was only 1,200. So it's almost doubled in a span of a few months. Especially when you think a lot of people say gold doesn't really have any tangible value. Its price is just shooting up and they're just using it to hedge against the stock market. So I think this is what people are doing with crypto, because people just can't hold cash anymore. It's such a poor alternative to any sort of investment, because you just lose money against inflation with 0% interest rates. For a lot of people, it's just not worth it. And they see gold and other metals as speculative as crypto anyway, so they might as well dump some money into cryptocurrencies whilst everything else is going haywire and they don't know where it's going to go anytime soon. So I do quite like the idea of holding a small amount of both physical and precious metals and crypto. I am, however, more geared towards crypto because over the long term, gold has always underperformed against stocks. Stocks have always come out on top. And crypto, however, is still relatively new, and obviously we've seen incredible growth in it in recent years. And I do quite strongly believe that in the future there will be a very good place for it. I think governments will start to adopt it. And that kind of goes against the idea of some of the crypto, but there are some, and it's definitely got a valuable real life application that will make it quite valuable. So I do hope to see it kind of explode again in the future. And I'm only putting a small amount as I know it is risky, but I definitely see its value compared to gold when companies are using gold to build, well, obviously like computer materials and stuff and phones and stuff. But I think the value of it is very overpriced right now just because people are speculating on it. Whereas crypto is relatively new and they're finding new applications for it every week, every month. So that's why I do see quite a lot of growth in the future for it. So that kind of sums up my portfolio update and my thoughts on the .com repeat. Do let me know what you think. If you're being quite skeptical of the market right now, I'd be very interested to hear. Also, of course, let me know how your portfolio is doing and what you think of mine. And thanks for watching. I'll catch you guys next time.